What's up, you guys? It's Graham here. So this is getting out of control. As of right now, the national debt is approaching $37 trillion. It's expected to increase by another $1 trillion every 3 months. And with interest payments recently hitting an all-time high, like it or not, there will be serious consequences for everybody watching if you aren't prepared for what's about to happen. For instance, in just the last week, we've seen investors literally selling America. Interest rates have been surging higher. Bitcoin hit an all-time highs. Investors left the dollar, and the entire financial system was recently downgraded, which is something we haven't seen since the great financial crisis. This is why we really have to talk about exactly what's happening, what this means for you, why the billionaire Ray Dalio says that the risks are greater than they appear, and then what you could realistically do about this to come out ahead profitable, especially since right now is the best time to make the most of it, or at least potentially save yourself a lot of money. Although before we start, if you appreciate videos like this and find them helpful, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. I know I don't like asking for it either, it's annoying, but it does make a significant difference for the channel, and as a thank you for doing that, here's a picture of a hamster. So thanks so much, and also a big thank you to Cookie Unity for sponsoring this video, but more on that later. Alright, now in terms of where we start, it all begins right here with the national debt. Think of this like, how much does a country have to constantly borrow to keep itself afloat? And as the billionaire Ray Dalio suggests, this number is growing more and more unsustainable by the day, leading to an outcome that he refers to as the changing world order. Now, I've mentioned this before in previous videos, but for those unfamiliar, throughout history, Ray Dalio explains that there's a repeatable cycle that happens when a country's spending grows to a point where there's no turning back, and he argues that the United States is already there. How? Well, the fact is, if a country can't sustain its own debts, it needs to choose between defaulting on its loans and printing more money. And it's always going to choose printing more money. That devalues its currency, raises inflation, and gives way for another currency or nation to take its place. Or I guess to explain it a bit further, according to him, the United States is entering a danger zone, with first, debt to GDP at 122%. This means that we are spending and borrowing more money than we're able to produce every single year. And as government interest rates continue to rise, it's recently hit a record high, now surpassing the amount that's being spent on national defense. Second, three forces are colliding at the exact same time, and that would be debt and monetary policy, internal conflict, and external conflict. In this case, he says that there's a huge amount of attention being justifiably paid to tariffs, while very little attention is being paid to the circumstances that caused them and the biggest disruptions that are likely still ahead. Third, there's also political division. In fact, according to polls, we are the most politically divided that we've ever been in history. For instance, throughout the United States, there are huge differences between someone's education, the amount of opportunity in front of them, the amount of money they make, and what they believe in. And when a government can't solve for these inequalities, both sides equally fight as hard to gain control, and that leads to less conviction throughout the rest of the world. That winds up with fourth, world orders breaking down. As Ray Dalio believes, we've taken an America First approach, rather than a multilateral, cooperative world order, which would be the best for everybody to foster as much growth as possible. And this comes at the expense of our long-term goodwill. This is partly why we've seen some massive changes occur throughout our economy in the last few weeks that very few people are paying any attention to, like the United States credit downgrade. Look, for those unaware, since the United States largely functions and operates on borrowed money, they're issued a credit rating that demonstrates the likelihood of repaying back their loans, which in this case are issued in the form of treasuries. In fact, every single country has a rating like this, and for a long time, the United States was considered to be the safest because not only are they the reserve currency, but they also have a perfect track record of paying everyone back on time as agreed in full without any drama. However, on May 16th, the credit agency Moody's downgraded the US in terms of their future outlook, going from what's called a AAA rating to AA1, while signaling that their outlook had gone from stable to negative. Why? Well, they've pointed out that Congress has continuously failed to reduce the national debt and borrowing. Over the next decade, they expect larger deficits as entitlement spending raises while government revenue remains broadly flat. Large fiscal deficits will drive the government debt and interest rates higher, and future performance is likely to deteriorate relative to past performance. Essentially, the US debt is growing unsustainably fast, revenues are slowing down, interest rates are going higher, other countries are looking better in comparison, and they they project that by 2035, interest payments will make up 30% of the total budget, which is insane. Like, imagine you, as a person, need $100,000 a year to survive, and $30,000 a year of that is just interest on the money that you owe. It's unsustainable. Now, even though the United States has never formally defaulted on their debt, and realistically probably never will, this does point to the fact that more than likely the United States will have to print more and more and more and more money. And if fewer investors buy that debt, interest rates will begin to rise like they have been for 5 main reasons. According to the Wall Street Journal, 1. More investors are jumping into the stock market rather than buying US debt, and that's causing interest rates to jump higher so as to entice people to buy them. 2. Investors are paranoid about rising prices, and if they believe interest rates will pay higher in the future, there's no reason to go and lock themselves in now. 3. People are worried about the country spending too much money, and they want to be compensated extra for that additional risk. 4. Other countries like Japan are paying more on their own bonds, which could reduce demand for US debt. And 5. There's the worry that tariffs could cause other countries to stop buying US treasuries, causing interest rates to go even higher, which is what started to happen. And this is where things get a bit crazy. Although before we go into that, I don't usually do this, but I had a sponsorship that was supposed to go right here, and I just couldn't bring myself to stick with the outline. So I'm going to be brutally honest. About a year ago, this company, Cook-Unity, reached out to me to see if I'd be interested in trying out their service. Basically, they explained that they have chefs prepare high-quality meals, you could pick them out online, they ship them right to your house on a regular basis, and because it's all made fresh, it's similar to getting restaurant takeout than it is a microwavable meal. So I said yes, I'd give it a shot. They sent me a week's worth of food, and no joke, I was totally blown away. This literally tasted like I was eating food cooked by a private chef, and when I added up the discounts they were offering, each plate came to be just $5.55 a meal. Like, for context, that cost me 50% less than what I'd order at Chipotle, and it tastes way better. So I said yes, I'd be happy if you sponsored the channel, and here we are. I currently order these on weeks where I know I'm going to be really busy. I simply go online and select from hundreds of meals prepared by award-winning chefs. They're delivered fully cooked, so all I have to do is heat them up. They have plenty of options under 600 calories if you're looking for something healthy, and lunch or dinner is done in as little as a few minutes with no meal planning or cleanup required. On top of that, their subscription is super flexible. You could choose from 4 to 16 meals a week, and they're commitment free, so you could pause or cancel at any time. If you want some specific recommendations, I recently loved the roasted salmon and lobster sauce by Chef Andre Mendez, mustard crusted salmon by Luda Lefebvre, and herb roasted salmon with truffle mashed potatoes by Chef Stacy Barang. So if you're interested in trying this out for yourself, just go to cookunity.com/Graham or use the link down below in the description and use the code GRAHAM at checkout for 50% off of your first order. Like I said, at their highest meal plan, that comes to just $5.55 a meal, which I'll be honest, I have no idea how they're actually making any money on this. I'm not going to question it, so enjoy the discount. Thank you so much, and now let's get back to the video. All right, now in terms of how this affects you, as Ray Dalio points out, a credit downgrade's not the entire picture. Instead, a bigger concern is devaluing the US dollar. See, here's the thing. In times of uncertainty, investors buy safe haven assets like United States Treasuries because our government is seen as the most stable place to park extra money. Normally, the more investors buy in, the less these treasuries have to pay because there's such high demand. But this time, the opposite is happening. As the stock market's been going up, Treasury yields have been going even higher, suggesting that investors in countries are not buying US Treasuries anymore, and the United States is left holding the bag. In fact, the head foreign exchange researcher at Deutsche Bank previously said that the damage has been done. The market is reassessing the structural attractiveness of the dollar as the world's reserve currency and is undergoing a process of rapid de-dollarization. Shortly after this, the Federal Reserve stepped in to say that they're prepared to intervene in financial markets if liquidity issues arise, basically reassuring everybody that if things get too bad, they're going to step in with the money printer and bail out the economy. And in a way, this is what they've already been doing. As you could see, after injecting trillions of dollars into the markets throughout 2020, they're still continuing to buy mortgage-backed securities in US Treasuries, albeit at a slightly slower rate, suggesting that they're still supporting the markets to some degree. and this is especially evident when you see that they've been doing this since 2008. At the core, there's just no way to sugarcoat it. Our debt is growing at an unsustainable pace, more and more money continuously gets printed into the economy, and at some point, it just becomes unsustainable. Now sure, they could reduce government spending, increase tax revenues, and slowly begin paying it down, but the more time goes on, the more this appears to be unlikely, especially when you take a look at the tax cuts. As of right now, a new tax reform is in the works that aims to extend the 2017 Tax Cuts and Jobs Act, increase the state and local tax deduction from $10,000, eliminate taxes on tips, and reduce tax on overtime work, among a variety of other initiatives that I'll cover in a future video. Although in terms of paying for all these tax reductions, House Republicans are voting to increase the federal debt ceiling by $4 trillion. In fact, the Yale Budget Lab calculated that it would add $3.4 trillion to the cumulative deficit over the next decade if tax cuts expire in 2028 and 2029 as scheduled, or $5 trillion if they are extended. And another analysis found that over the next 10 years, another $9 trillion could be added to the national debt. On top of that, this is not a Democrat versus Republican issue either, because as you can see, over the last 80 years, both sides have operated at a loss, with the only exception being Bill Clinton, who raised revenues in part due to the dot-com bubble, but only by 2.3%. Of course, in terms of who owns this debt, 42% is held by private U.S. investors like Warren Buffett, 20% is held by government agencies, 13% is held by the Federal Reserve, and the other 25% is held by foreign buyers like Japan, the UK, and China, which is a number that's risen by fivefold over the last 50 years. This just means that realistically, government debt is going to become more and more difficult to sustain. Interest payments are already outpacing the amount being spent on defense and Medicare, and as the debt becomes more and more expensive to finance, the repercussions are going to be felt practically everywhere as interest rates have to increase to attract new money, and that of course will continue to devalue the dollar. For example, mortgage rates have just now risen back above 7%. The 30-year Treasury yield recently passed 5%, and this means borrowing money for most people is going to become a lot more expensive. Like, this is what Warren Buffett previously had to say on this. He says that if the government rate rises, the price of all other investments must adjust downward to a level that brings their expected rates of return into line. Consequently, every time the risk-free rate moves by 1 basis point or by 0.01%, the value of every investment in the country changes. Essentially, all this means that if people lose faith in the United States, interest rates are going to have to rise to compensate for that additional risk. Prices of other assets will likely begin to fall, and that means the more likely you are to be affected. So in terms of what I think of this and what you could realistically do about this to come out ahead, here's what you came for. In terms of the national debt, I'm going to be honest, I don't see it getting better anytime soon. The dollar's on an unsustainable path, government spending is out of control, and neither side wants to do anything about it. Is this something that's going to tank the economy overnight? No, but over the next few decades, it's something to keep in mind, because eventually it's going to have to get dealt with. Until then, though, just expect more money printing, more bailouts, and this can continue for a very long time. That's why for the average person who simply wants to make the most of what's in front of them, I'm a big fan of number 1, make sure you don't hold on to too much cash. Now, that's not to say you shouldn't have an emergency fund or some cash on the sidelines for something you're saving up for, but it is to say that you probably shouldn't stay out of the market for many years in a row. Otherwise, you're going to be losing purchasing power. Number 2, you should diversify your investments throughout as many different sectors as possible. The fact is, the more you spread out your money, the more you reduce volatility and risk. And this is the approach that I've taken. That way, should one market fall, the others should more than make up for it. For example, over the last 50 years, whenever inflation has increased past 5%, gold has provided an average annual real return of 10.35% during a time where stocks had negative returns. 3, you should also ignore the negative news and just keep buying in as usual. Study after study shows the best thing that you could do is simply to keep buying in the market no matter what the price is, don't panic sell, and hold. Not to mention, if you just miss out on the top 10 best days in the market in a 30-year period, you'll lower your returns by half. 4, make sure you keep a steady income. I've said this before, but one of the biggest risks is simply losing a job at the time the market is down and we hit a recession. This is why it's so important to keep a consistent income, to be able to buy in these dips, or at least reduce your expenses so that you have some extra money to fall back on. 5, it's also probably better that you stay at a margin or leverage. I think it's pretty safe to say that you're playing with fire anytime you borrow money for the sake of investing. It's probably not a good idea unless you really know what you're doing or just have an appetite for a lot lot of risk. And finally, 6, if you need the money for a specific purpose over the next 2 to 5 years, it's probably a good idea not to invest all of it. The reality is, a few years is not a long enough time frame to ensure that you're actually going to make money in the markets. And as we've seen throughout history, there have sometimes been decades where the market has not recovered and you would have lost money in the short term. So the longer your time horizon is, the more likely you are to actually make a profit. Honestly, I don't think our current path is sustainable in terms of national debt and spending, but at least following this should give you the best chances of coming out ahead profitable in the long run. And of course, I'm open to hearing your comments as well, so feel free, let me know your thoughts down below, and I do my best to read and reply to as many of you as I can. So thanks so much, I really appreciate it. Make sure to like and subscribe if you haven't done that already. I really appreciate it, and until next time.